This is Eric Muathe with Muathe.com. All is well. Let's take a look here at an example of why we should be careful when we are looking for breakouts for stocks that do not seem to hold on to past gains. For example, here we can see a stock that I was considering as a potential candidate, but I had to really discard it from my list because of here we can see that it lost a lot of gains. As we can see, the high for the week was here, intraday high for the week, but the close for the week is off the high somewhere here. It's not a good week in my opinion. And again, we can see something similar recently where we see we had a good movement in price. This is the high for the week, and this is the close for the week. So what we can see here is some type of evidence that the stock does not, for some reason, hold on to gains, which means that if you buy it when it's moving, it's actually going to do the same thing more than likely. It's going to frustrate you, it's going to gain, and then just all those gains are going to evaporate. So we, as best as we can, we do our best to avoid those types of scenarios. In fact, it's good practice to go back and take a look at as much historical data as possible. Here we can see all the data, and we can see this type of action where, yes, there's some nice movement here and then, but followed by drops. And we can see another drop here, loss of drops as we've seen here, and actually even here on a monthly basis, lost the gains here, lost the gains here. So this is just one of those instruments that doesn't feel like, even though on the surface we can say it meets the minimum requirements for the ultimate Muathe breakout with the RSI at 3-year high, so it does meet the minimum requirements. At least one of the MACDs is needed, so we have the minimum requirements being met for the ultimate Muathe breakout. The issue here is past performance, and we have to be sensitive to this. Now, example of this is a stock I was covering a couple years ago, TRXC, and I made a couple of videos just explaining this concept, because you could see big drops, loss of gains here, a big reversal. This is the high for the month, this is the close and the low for the month. That's not what you want for a stock that has potential. And we can see again, we lose gains here for the month, and then we follow by a big drop the following month. So as the stock was moving higher as of mid 2018, I just felt this was potentially one of those that distracts just based on past performance. And in fact, if we take a look at a longer point of view from the same stock, we see this up and down. We have this up and down movement. Here we can see a huge loss of gains in 2003. Again, this is something this instrument does. We had a nice period here. I can say that was good. But notice all the give back in gains. Give back in gains on this month. Give back in gains here. Huge drop. Give back in gains here, because it closes right here at the lows for the month. And then we can see this behavior. So this is something the instrument does. And you want to avoid those types of stocks, because actually after that breakout, or what looked like a good breakout in 2013, what followed was nasty. And if I update the chart to reflect current price action, we can see that it reverses as of September 2018. And since then, from a split adjusted price, it has pretty much gone to zero, effectively gone to zero. This is what I'm talking about. You want to avoid these types of stocks that seem to have a tendency never to hold on to gains, because they'll do the same thing while you own them. They won't change their behavior. So it's always risky to own these types of instruments. So you always want smooth action. Now consider this price action from 2013 to 2020. This is all over the place. Very ugly looking chart. Compare it, for example, with Microsoft, which has done well in the same time period. All right, take a look at the same stock again. Not very stable price action. And take a look at Amazon. Now, of course, I'm cherry picking to some of the best instruments in the US, but just trying to give you a visual of what you're looking for. Again, take a look at this, which is very unstable, and take a look at Apple, which is very stable. Even when it bases, the base formations are constructive, sideways to down, and then a breakout takes place at some point. So again, we need to avoid instruments that are showing that over years and over time they tend to give back gains. And the warning here is, when you decide that they are ready to move, they're going to end up losing you money and frustrating you. In other words, this is what I call ugly looking charts. Avoid them and be on the lookout for stable, bullish momentum instruments. Eric Muathe, Muathe.com. Love and light, light and love. Namaste.